Welcome back to Primary Source China Investment. This week we're on show B4. And if you recall last week, we really went after the foreign managers managing China stocks on the mainland and in Hong Kong. And we were saying that alpha is dead. Well, this week we're back and we're looking at mainland investors on the mainland. And there is actually a little bit of good news. There is some what might be called alpha out there, and we're going to get into that. Before we do, all of the data that we're presenting today is provided by Chris Zhang from Fortune Securities. He was on the show many months ago, but we'll really appreciate him sending that over to us. It is also all as of the end of September. So very briefly, we're looking at the private fund managers this week. Just to give you a sense of scale, there are 24,000 private fund managers with 140,000 individual products, and they manage just under $3 trillion equivalent. About 65% of these funds resemble what we might be calling a hedge fund, and the remaining focus on things like private equity and venture capital. So we're going to stay focused in the hedge fund cohort, and we're going to stay focused on long-only funds. So we have a comp with the CSI 300. So some of the good news was the average hedge fund was down about 10%. Remember, the CSI 300 was down 23%. Of course, there are plenty of strategies that fall under this hedge fund banner, but we're just focusing on the long only. There are more than 18,000 qualifying funds. The average return was negative 14.77, which is a huge outperformance. As we said, the CSI 300 was down 23%, the average long-only fund. And we're going to get into some of that detail. There's no one reason for this, but perhaps the biggest is cash. A lot of the managers, when the market goes down, they will allocate into cash. So when we say long-only, that's a pretty broad definition. Am I right here, Peng Guo?
Yes, they usually call the 仓位.
Right.
That means the percentage of the cash. So I think the key skill is adjust this kind of the percentage of the cash, and you will outbid the index.
Yeah, especially this year in 2022, the market started just as of January, started going down quickly. So a lot of these guys rotated to cash. So that's great in a down market, but if market timing tells us anything, it's very hard to pick the bottom, and most managers will underperform or lag when the market goes up. Interesting, there was no portfolio drift. A lot of times when there's outperformance, it's that you're deviating a lot from the index. And remember, a lot of these funds are not using CSI 300 as the index because they're investing in small caps or micro caps or other kind of,
That's exactly right.
stock. But it's interesting to note that this year, CSI 300, the top 300, CSI 500, the next 500, and CSI 1000 were all down between 19 and 23%. So this was not a drift outperformance because all of the stocks performed poorly. So I do think there's a lot of this rotation to cash. Maybe there was some overinvestment in energy, some sector rotation, but by and large, all of the stocks, large cap, medium, and small cap, were all hit pretty hard this year.
That is what I keep saying called a systematic risk. So this kind of the risk, and the people should be try to manage or try to not completely avoid, and should have the strategy in their investment to reduce the impact of such kind of risk. Without it, and you will be hurt sooner or later like this.
There's also another point that you brought up last week, which was the discussion about absolute return and relative return, right? Managers may not get rewarded for being down half the index. If you're down 10 and the index is down 20, well, people still look and say, oh, I'm down. So they really want absolute performance in a down market. And then when the market
even you get a flat, then the people still not happy. We put the money to your place for half a year or almost a year. You don't have any return.
Yeah. So this is an educational issue, right? That's
right. Yeah, that's the expectation. Yeah,
it's the feeling, So recently I was asked about mainland regulators granting more access to foreign financial firms, and is now a good idea to invest for the long term because we're seeing some news that foreigners are buying up buying up to 100% of their JV, or they're buying out their JV partner. We're also hearing new entrants getting in under the WOFI structure, and a constant drip of new participants. I think it would be arrogant to summarily dismiss these private fund managers. Never mind the massive amount of asset managers that have been in the business since the beginning, over a quarter century ago. Recall in show J3, we'll put a link in, we discussed JP Morgan's business on the mainland and how after 20 years, the business is still small and expensive to manage. So maybe the strategy is partner or buy out or somehow link up with some of those larger private fund managers, because there are a number of them that are quite large now and have been doing this for many years.
They do. I know there's some of like the top fund manager. They already take like the foreign investors' money, and so they, like the Fidelity also have their own private fund, and many big names they already started their own private fund to do it. And the next big question is marketing. That also is a tough one. You still need to go back to deal with channels to market your product.
Yeah, I look at the marketing is daunting, right? Because everybody is going after the same client base. Although it's a big client base, everybody's sort of doing the same thing. It's a combination of online and visiting the securities, the securities entities and the branch offices and all those other kind of things. But my argument is, if you want to start a business on the mainland, you have a huge amount of competition, not only from the established players, like we talk, China Merchants Bank. You're going to compete with China Merchants Bank. Even Ray Dalio, his all-weather fund, the biggest name in hedge funds globally, raised what, $1 billion? I mean, if he's managing $1 billion on the mainland, he's losing money, full stop. And he manages $65 billion. So 1 billion on 65, it's a tiny portion and requires a huge amount of regulation, a huge amount of resources. So maybe it's better to buy into a successful brand instead of exposing your brand to all of the China-specific business risks.
I totally agree. Yeah, that's still they get a lot of the challenges and a lot of the work, and they might not expected before. And also, that really means the China market is a high efficient market. So because so many active managers, that's just means the index fund will be get better sooner or later.
I absolutely believe that. And then, last week, what we talked about is if you're actively managing against the index and you're fully invested all the time, you're losing. We demonstrated that. Big brands, JP Morgan, Morgan Stanley, Goldman Sachs, Matthews Asia, the smartest people in the room, they are lagging the index. Before we go, we promised we'd talk a little bit about fixed income, but we're going to do it in a little different way this week. It's hard to be a private manager of fixed income. Remember, these private managers charge a 1.5% management fee. They may charge a carry of some sort. So the economics of fixed income is difficult because you're largely looking at single-digit returns. So if you're going to pull out a management fee and you're going to pull out a performance fee, what's left for the investor is not so much. But if you look at the bond strategy, the active managers, the private managers following fixed income, they actually have lagged a lot this year. So the China bond index is up 3.63%, and the bond strategy is only up 1.5% this year.
Bond strategy is still different. We talked about this before. I think there's always be good to add a certain bond of that strategy, and you can easily to make the calculation to figure out that the Sharpe ratio is much better than pure bond or pure stock.
Well, the final thing is we're going to put up a chart of all the different strategies on the mainland, and you can see year to date, all of them are down except that small uptick in the bond strategy and the managed futures. And that seems to be a very popular strategy. There's a lot of foreigners following the managed future strategy as well. But by and large, it's been a very, very rough year. There's some discussion about, oh, maybe we're finding the bottom and some people are starting to buy. Again, a lot of headlines about are they or are they not going to stop COVID? I think all of that is just noise. It's you have to get demand back to the market.
That's called an event-driven strategy.
Yeah, exactly. I'm not betting on
So
that.
you get an event personally, and then the market reacted. So that's no way to guess.
There's way too much volatility. People jumping in and jumping out of stocks. It's just a silly way to invest. So we don't recommend doing that. Don't recommend doing it. Well, that's great for show B4. Thanks for tuning in. Make sure you subscribe, and we'll see you next week.
Thank you.